Chapter 19. There are 5 components of financial statements. Statement of profit and loss account and other comprehensive income that we have covered in chapter 17. Statement of financial position that we have already covered. Statement of changes in equity that we have covered. Statement of cash flow that we're gonna cover now, and a notes to the accounts and disclosures. There is no set format. You will learn these notes in higher level accounting papers. So we know how to prepare this, we know how to prepare this, we know how to prepare this. Now in this chapter, we will learn how to prepare statement of cash flow. Before moving to start statement of cash flow, suppose company have made a sale of 100%. Whether company will be having a cash of 100,000, cash should be same or should be different. If company is having sale of 100,000, what could be the amount of cash? Either same 100,000? No, because there could be some credit sales, some cash sales. So cash figure could be different than sale figure. If we want to know company made a sale of this amount, that we can find from statement of profit and loss account. What amount of cash companies are having at the year end? That we can find from statement of cash flow. That we can find from statement of cash flow. How to prepare statement of cash flow? There are 2 methods of preparing statement of cash flow. There are 2 methods of preparing statement of cash flow. One is called a direct method and other is called indirect method. Direct method and indirect method. While preparing statement of cash flow, we need to see how much cash flow company is having from operating activities. Operating activities mean activities relating to profit and loss account. Relating to profit and loss. We need to calculate cash flow from investing activities, where company invested some money into assets, non-current assets. Any kind of investment. Investment could be either in any company. Investment could be either in any property from where company is receiving rent income. Investment could be in any other company where from company is receiving a dividend. Or company invest money into non-current assets. If company is selling any asset, that should be recorded cash outflow under investing activities. Company buying any asset, that should be recorded as cash outflow under investing activities. Selling inflow, buying cash outflow. And we need to calculate cash flow from financing activities. Cash flow from financing activities. Financing, where from company source finance? Company take finance by issuing shares. In how much company received cash by issuing of shares? Company take money through loan. Company can take money through loan. Or company pay money with a repayment of loan. Loan is also called debt. So while preparing statement of cash flow, we need to calculate cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. And we will add all these three. We will be having an ending cash balance. Now let's discuss how to prepare statement of cash flow. What is the format of statement of cash flow? There are two methods to calculate or to prepare statement of cash flow. Let's discuss about direct method first. We will put a heading statement of cash flow for the year ended 31st December year end. First, we will calculate cash flow from operating activities. How we can calculate cash flow from operating activities? First, we need to calculate cash generated from operations. From cash from operations, we will deduct interest paid. We'll deduct tax paid. We will arrive at net cash flow from operating activities A. Then we will calculate cash flow from investing activities. We will arrive at net cash flow from investing activities. Then we will calculate cash flow from financing activities. We will arrive at cash flow from financing activities, and then we will add A, B, and C. We will arrive at net increase if positive figure or decrease if negative figure. And then we will see what was the cash at start of the year. In opening figure, we will adjust that. We will be having closing figure of cash. So in direct method, only the difference between direct and indirect method is to calculate statement or a cash flow from operating activities. Only this will be different. How to calculate cash flow from investing activities or financing activities, it will remain same for both methods. In calculation method for financing activities and financing activities will remain same under direct, under indirect. Only to calculate cash flow from operating activities will be different under direct and indirect method. So under direct method, how to calculate cash flow from operating activities? Cash from operations, less interest paid, less tax paid. How to calculate this cash from operations? There is a formula. Cash generated from operations, how we can calculate this? We need to calculate cash received from customers. From this, we need to deduct cash paid to supplier and cash paid to employees in terms of wages and salaries. We will arrive at cash generated from operations. Cash received from customer minus cash paid to supplier minus cash paid to employees in wages. We will arrive at cash from operations, and for cash from operations, we will deduct interest paid and tax paid. We will calculate net cash flow from operating activities. Is it fine? But these figures are not normally easily given in the question. We have to find out how cash received from customer might be in question. You are having opening balance of receivable, you are having closing balance of receivable, you are having credit sale figure. You can find balancing figure as cash received from customers. For cash paid to supplier might be you have to open the payable ledger, its opening balance, its closing balance, cash purchases, and you have to find the Balancing figure cash paid to suppliers. For wages and salaries, might be you are having a accrued wages account. Opening balance, closing balance, charge to profit and loss account, and you need to find the cash payment balancing figure. Is it fine? Even might be for this interest paid and tax paid, you have to open their account, accrued interest account and accrued tax account. Now let's discuss a question. Yeah, this example. The statement of financial position of a business were as follows. Non-current asset this year, last year, mean this is the opening balance last year, and this is closing balance. Mean this is closing and this is opening. Inventories not there. Receivable opening balance, closing balance. Cash closing balance. Share capital opening closing balance. Reserve current liabilities opening closing balance. Current liabilities. Current liabilities mean payables. They have given you sale figure. Under cost of sale, they have given you purchases figure. They have given you wages and salary figures. Operating cost, salaries charged to admin staff, salaries charged to production staff. And they have given you some other information. Current liabilities consist of trade and other payable opening closing balance and wages accrued opening closing balance. What we need to do? Purchase invoice relating to acquisition of non-current assets totaling 80,000. This is relating to investing. Have been posted to the payable ledger during the year. Calculate the net cash flow from the operating activities using the direct method. Using the direct method, we need to calculate what? Cash flow from operating activities. And first, we need to find what? Cash received from customer. We need to deduct cash paid to supplier, cash paid to employees in terms of wages. We can calculate cash from operations. From this, we need to deduct interest paid and tax paid, and interest paid, tax paid figure are not there. This means we need to calculate only cash from operations. So cash received from customer, for that we need to open receivable ledger. Is there any opening balance of receivable? Yes, how much? 265,840. 265,840 and closing balance 340,600. Is there any 346,000? Is there any sale figure? Credit sale? Yes, 1589447. So we can find balancing figure as cash received from customer. How much is that? Please calculate. How much is that?
Zero nine two eight seven
1509.
287.
1509287. Now cash paid to supplier, we need to open payable ledger. Payable ledger opening balance they have given here 210,564. What is the closing balance they have given? 258,240. 258,240. And is there any purchases given? Yes. 11,05830. What is the balancing figure of cash payment? What's the balancing figure of cash payment?
We are not adding operating cost
Where the operating cost?
in payables.
Opening balance, closing balance, purchases, and we need to calculate cash figure. Operating costs are not relating to purchases, they are expenses. 1058,
154.
154. Now we need to calculate wages. So accrued wages account we are having. Its opening balance is 8640. It's a liability, and closing balance 14650. And wages charged to profit and loss account. How much charged? 145,900 and 100,000. So we can calculate cash payment. How much is that? Three nine
893.
890. So this is cash receipt, this is payment, this is payment. Through this, we can calculate cash flow from operations. There is no interest paid, there is no tax paid. So that's fine. Why they have added these operating costs 96077 in payable ledgers. There's no link in payable ledgers because payable is relating to purchases. Is there any adjustment they have shown? Purchase invoice relating to acquisition of non-current assets totaling 80,000 have been posted to payable ledger control account. Yes, they included 80,000 into payable ledger. Mean this is relating to non-current assets. In payable, we need to see for inventory only. This means this 80,000 we need to deduct from payable ledgers. How we can deduct? By debiting it. Why they are adding this 96077? Might be there is some, these operating costs are not relating to payables. These are admin expenses. These shouldn't be part of payables. These shouldn't be part of payables. So we can just deduct those 80,000 from here. And by deducting those, we will arrive a figure different of cash paid. And then we can compare three figures and we can find the answer. There is no tax paid, there is no interest paid. We are having one more question. Using the direct method of presentation, prepare a net cash flow from operating activities for the year ending 30th September 2028. These are the information. We are having opening balance of receivables, closing balance, payable opening, closing balance, accrued wages, opening, closing balance, interest payable, opening, closing balance. Through this, we can find interest paid, tax payable, opening, closing balance. Through this, we can find tax paid, sale figure for receivable ledger, purchase figure for payable ledger, wages figure, charge to P&L, and interest expense charge to P&L, and income tax charge to P&L means similar accrued wages. We will open these three accounts. Through this, we will find interest paid and tax paid. This question I am leaving on you. This is your homework. You will do by yourself. Is it fine? So let's discuss the complete format of statement of cash flow. So under direct method, cash flow from operating activities, for that we need to find cash from operations first. How? Cash received from receivables, less cash paid to suppliers, less cash paid to employees in terms of wages and salaries. We will arrive at cash from operations. From cash from operations, we need to deduct interest paid, tax paid. We will be having a cash flow from operating activities. How to calculate cash flow from investing activities? Purchase of property, plant and equipment, cash going or coming in. If we are purchasing non-current assets, cash going or coming.
Coming.
If we are purchasing asset,
Going.
going, that will be called outflow.
Outflow.
Outflow will be negative figure. Inflow will be positive figure. Proceed of sale of equipment, we sold some equipment. So inflow, positive. Interest received,
Positive.
like we invested in bank account, saving account, we are receiving interest, this is inflow. Dividend received, like we have invested in any company, so we are receiving dividend, that is inflow. So we will add these, so we'll be having cash flow from, net cash flow from investing activities. Then we will calculate cash flow from financing activities. Proceed of issue of shares. I mean, if we have issued shares, there is inflow, positive. Receipt of loan. If we have obtained loan, so cash is inflow. Repayment of loan, outflow. Dividend paid to whom? Shareholder, outflow. So we will calculate net cash flow from financing activities. And by adding all three, we will arrive at net increase or decrease in cash. If positive, increase; if negative, decrease. We will add opening cash balance. We will arrive at closing cash balance. So this is the method to calculate or to prepare cash flow statement from direct method. Under indirect method, only cash flow from operating activities calculation will be different. Investing and financing will remain same. So let's discuss how to prepare cash flow statement from indirect method. Under indirect method, how to calculate cash flow from operating activities? We will start from profit before tax figure. That will be given in profit and loss account. If profit after tax is given, what we will do? We will add tax to arrive at profit before tax. Then we will add back all expenses relating to investing or financing activities as well as non-cash items. What are non-cash items? Depreciation is non-cash item. Amortization of intangible asset is non-cash item. That we will add back. Loss on sale of asset, that is expense relating to investing activities, we will add back. Interest paid, that is relating to financing activities, that's why we will add back. This is the figure charged in profit and loss account. And we will less income relating to investing financing activities. Profit on sale of asset, loss we will add, profit we will deduct. Interest received, deduct. Dividend received, deduct. Rent received, deduct. And then we need to adjust, increase or decrease in current assets and current liabilities. What are the current assets and current liabilities? Inventory, receivable, payable, any prepayments as well. Prepayments, inventory, receivables are current assets. Payable is current liability. Either we need to add it or minus it, let's discuss. Current assets. What are current assets? Inventory, receivables, prepayments. If current assets increasing, is there inflow or outflow?
Inflow.
Current assets are increasing. Current assets suppose inventory increasing.
Outflow.
Out. So we will deduct it. In minus figure. If current assets decreasing,
we have to add.
then we are selling inventory. We are receiving money from receivable decreasing. So that we have to add. Is that fine? And in case of current liabilities, if current liabilities increasing, reversal effect mean positive.
Positive.
If current liabilities decreasing, that will be negative. Current liabilities increasing mean we are getting benefit from supplier. So that is inflow. Current liability decreasing, how? We are paying cash. So cash is going in out. That's why it is outflow, negative effect. So profit before tax, we need to add back expenses relating to investing, financing activities, as well as non-cash item like depreciation, amortization. What could be the expenses? Loss on sale of asset, interest paid. And we need to deduct incomes relating to investing, financing activities like profit on sale of asset, interest received, dividend received, rent received. And we need to adjust, increase or decrease in current assets, current liabilities. This is also called working capital changes. Mean we need to adjust working capital changes. Working capital changes mean increase or decrease in current assets and current liabilities. Whether we are having inflow or outflow from inventory, whether we are having inflow or outflow from receivables, from payables, from prepayments. And from this, we need to deduct tax paid. We will arrive at net cash flow from operating activities. So we will start from profit before tax indirect method, cash received from customer, cash paid to supplier, cash paid to wages, less interest paid, tax paid. But using indirect method,
We have to.
we'll start from profit before tax. We will add back loss on sale of asset, interest paid, depreciation, and we will deduct
Less income.
incomes relating to investing activities like profit on sale of asset, dividend received, rent received, interest received. And then we will add our less working capital changes, meaning increase in current assets will be deducted as outflow, decrease in current assets will be added. Increase in current liabilities will be added while a decrease in current liabilities will be deducted. And then we will deduct tax paid and we will arrive at net cash flow from operating activities. While calculation of net cash flow from financing investing activities will remain same. Let's move forward. Let's cover this. These long questions we will cover in Git. Let's move towards some short questions. Seven is also long. It is also long question to prepare cash flow statement. Test your understanding 9. Part of an entity statement of cash flow is shown below. Profit before tax, loss on disposal. Disposal means sale of asset. Increase in inventory, increase in payable. So in profit before tax, whether loss on disposal we add or deduct?
Add.
Add. Income deduct, expenses add. Increase in receivable we add or deduct?
In receivables,
Receivables are increasing, current assets increasing.
deduct.
No, this is the direct. Increase in receivable, increase in inventory. Cash going out. Cash going out, we need to deduct. This is outflow. Increase in payable. Obviously, this will add. The following criticism of the extract have been made. Which of the criticism is valid? The loss on disposal should have been added, not deducted. Is that fine?
Yeah.
Yes, we have added. Increase in receivable should have been added, not deducted. No, this is wrong. Increase in payable should have been deducted, not added. No, this is also wrong. Which criticism is correct? For now. Technical. Technical. Receivable, think about its current assets. Inventory is also current asset. If inventory increasing, this means we are purchasing inventory, cash going out. If inventory decreasing, this means we are selling inventory, cash coming in. And for payable, increasing mean we are getting more benefit from supplier. Decreasing, we are paying them, cash going out. Test your understanding 10. Which of the following could appear in an entity's statement of cash flow? Proposed dividend? No, dividend paid.
Paid.
Dividend received?
Yes.
Bonus issue of shares. In bonus issue, there is no cash involved.
Yes.
Surplus on revaluation of non-current asset. There is no cash involved.
No.
We debit asset, credit revaluation surplus.
It's only
There is no cash involved. So only two
options.
Good luck everybody for test your understanding level. We need to calculate cash generated from operations. Using indirect method. Mean before tax paid deduction, there is cash generated from operations. Mean this format we have discussed. Where is that? 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 Yeah. Before this, we can calculate cash generated from operations. And from that, we will deduct the tax paid. We will arrive at net cash flow from operating activities. So good luck, everybody. You need to calculate cash generated from operations. That's your understanding 11. Yeah, this. We have moved towards answers. This is your question. By that, please. We need to add back expenses relating to investing, financing activities, as well as non-cash item. We need to deduct incomes relating to investing activities. We need to adjust. We add less working capital changes to arrive at cash flow from operations. Cash from operations. Cash generated from operations. Inventory decreasing as compared to previous year.
Yeah.
Receivable
In-
decreasing. Prepayments
Increasing.
increasing. Trade papers
Decreasing.
decreasing.
Interest payable.
Interest payable.
Decreasing.
Whether nobody use interest payable?
No.
No. This is used to calculate interest paid.
And these are.
So what is profit before tax? 434,850. Depreciation, we need to add back 37,400. And then this include an amount of 7,600, which was the loss on disposal of non-current assets. Depreciation 37,400 was charged to statement of profit and loss account. And this include an amount of 7,600, which was, is that 7,600 included in depreciation?
Loss.
The loss also we add back. That's fine.
Yeah.
Don't need to even separate it.
Separate.
Finance cost,
We have to add.
interest, we have to add 35,000. And then inventory decrease
By 20,000.
by 22,000 we need to add
Yes.
because cash coming in by selling. Trade receivable decrease by 1,000.
1,000.
Add inflow. Prepayments increase by 11,000. So this is a cash outflow. We have made advance payments, cash out. trade payables decreased. Trade payable decrease.
Yeah, decrease
This means we have paid cash. How much?
16,000.
16,000. So how much is cash flow from operations?
503250.
503250, option D. That's it, chapter. Finish.
Yeah, and this.
Finish. We'll see you next week. There are 3 chapters left. No,
On Saturday,
no.
in our timetable, it's shown that BT class is from 9 to 3.
No. We'll remain on normal classes.
One day.
There is no need for extra classes. So there are 3 chapters left. 2 chapters are relating to consolidation, and 1 is relating to ratios. Ratio analysis. So see you next week.